So hello and welcome to Crypto CFO's Water Cooler Wednesday. Today we have a guest, Patrick Camuso. He is a pioneer on the sales tax front for NFTs and kind of educating people on this aspect, which is often overlooked. Now, a lot of people are out there selling NFTs, and most of the time they don't really consider the tax implications that this kind of brings on them. So some of the things that we look into are things like nexus, whether it's the seller's point of view or the purchaser's point of view. And this is going to depend on what state you're looking at. And so I just wanted to kind of introduce Patrick, let him give a little quick introduction on himself and his background, and then we'll get into a couple of questions we have for him. So take it away, Patrick.
Yeah, I appreciate the introduction. My name's Patrick Camuso. I own Camuso CPA, where I've been doing digital asset accounting and taxes since 2016. Recently, I went down the NFT sales tax rabbit hole while advising some clients regarding the potential tax implications related to this, and that's sort of what led me here today.
So one of the things I wanted to ask you is kind of what are the existing states with like clear guidance on this, and kind of like where, like, let's start off from there.
So there's 31 states that have sales taxes that apply to digital goods and products, but there's only a handful of states that have provided tax guidance related to NFTs. The most notable is Washington, who's provided the most detailed guidance to date. We saw Pennsylvania come out with guidance after them, who out of all the states has probably provided the most limited guidance. We've also seen Minnesota, Michigan, and Wisconsin. So just a handful of states. And like I said, Washington has provided the most detailed guidance, with Pennsylvania providing the least. And then places like Wisconsin and Michigan sort of in between with fact sheets and bulletins that they put out.
Okay, cool. And so the remaining 31 that don't kind of have clear guidance on this, but have more of a digital, I don't know if I forget whether you said digital asset or
digital,
what, but
yeah. Digital
goods, yes. Okay.
Any type of digital downloads and stuff like that.
Okay. So what in your opinion is like the likelihood that some of those existing on the books digital goods regulations will apply to NFTs?
I think a very high likelihood, because states that have provided guidance like Washington and Pennsylvania have stated that this is interpretations of their existing tax laws, because they also tax digital goods. So they're just applying, it's not like they're issuing new laws, they're just applying guidance related to NFTs off of the existing laws. And they've also stated that these taxes, as a result of that, could be applied retroactively as well, which can be a large threat for any company selling NFTs as well as the industry as a whole.
Awesome. I think Brian had a question for you real quick. Brian, do you want to jump in real quick?
I was just wondering, is there a difference in how the sales tax applies based upon what an NFT is tied to, whether it's tied to a utility or to, or if it's simply art?
Yes, that is, there's really three factors that are going to impact the overall when sales taxes applies to an NFT sale. One of them is going to be, what is the underlying product or service associated with the NFT. So again, like Washington has the most detailed guidance, where they're really looking at 4 different scenarios. One is standalone NFTs. So that's the one, when we're talking about NFTs, we're probably thinking of the most, just any piece of art that you purchase. Those, according to Washington, are going to be taxable. Again, this is going to vary on a state-by-state basis. Then Washington goes on to define 2 other sections, which are transactions where someone's purchasing an NFT in order to obtain an underlying product. So this could be like if you sold an NFT in order for someone to be able to obtain tax or accounting services from you. Or you can maybe sell an NFT and someone can redeem that to purchase a product in your e-commerce store. In those scenarios, when sales tax applies is going to vary based off of what that underlying product is and when sales tax applies to those products in the state. So, you know, in that example in Washington, if the NFTs for a tax service, most likely that's not going to be taxable. But if it's to redeem an NFT on your website to get some type of e-commerce product, in that case, it most likely would be taxable. And then Washington goes on to define one other type of NFT transaction, which is royalties. In Washington, they apply a B&O tax, a business occupancy tax on royalties. So they also stated that applies to NFTs in that context. So that's a very good question. And it just largely is going to hinge on the exact type of NFT.
Well,
So
great detail.
Follow-up question on that. So like a state like Massachusetts, for example, there's no sales tax on apparel. There are some instances where apparel could have sales tax, but in general, we don't have sales tax on apparel. So let's say you're Nike, and for example, you sell an NFT that represents a shoe in the metaverse, but if you burn it, you get the actual shoe in real life.
Yes.
So in that instance, and we're assuming that the sale happened, and like let's say Nike's headquartered in Massachusetts for this example.
So they ship to Massachusetts. So it's a permanent sale.
Sorry, say that again, Brian.
Would it be? It's where the sale occurs, right? So if the sale occurs in Massachusetts, that's where we'd apply the sales tax.
Well, that's actually a whole different can of worms in terms of like where you're going to source the sale. And I'm happy to get into that, but going back to like if there's a combined, there's another consideration on if you're selling two products in what would be referred to in many states as a bundled transaction, which Washington has also given guidance regarding bundled transactions. That's basically where you can be selling multiple goods or services for one non-itemized price. In most cases, those are going to have sales tax applied to it. If you know, one or all of the products has sales taxes applied to it. And you know, there are like some very limited examples that Washington provided where that wouldn't be the case, but most bundled transactions you should assume is taxable. Now the sourcing is a whole nother can of worms, Brian. And that I think is probably one of like going to be the biggest contentions with getting any company into compliance when it comes to NFT sales taxes. And that's because if you're going to source the sale and determine where it's taking place, you're going to have to know the address of the purchaser. In most cases, because usually sales taxes is going to be based off of the address of the purchaser in most states. Now, Washington, in their interim guidance, it's been interesting because they seem to understand the overall nature, you know, the pseudonymous and anonymous nature of non-custodial wallets that people are transacting with, and the fact that, at least historically speaking, people have not been collecting their customer data for most NFT sales. So they listed a hierarchy on when sourcing, how sourcing is going to apply based off of the information that the seller has. And it basically starts with, like if it's an in-person sale, which is not most NFTs, then it's going to take place like where that sale took place. But then the hierarchy goes to the purchaser's address, basically. And then the last part of the hierarchy is if you don't have the purchaser's address, it's going off of the seller's address. So I think that's important, and it's going to be interesting to see if other states follow suit there, because I think that can position Washington very strongly from an enforcement standpoint, because then they can just basically look through at marketplaces or sellers within their state and audit them and basically apply, you know, sales taxes to all of their NFT sales.
Yeah, I think in your guest chapter you mentioned, by the way, Patrick is writing a guest chapter for our new release of our book, and in one of the chapters he mentioned that hierarchy. And you know, the challenges here is that like a site like OpenSea is permissionless. It doesn't require you to provide KYC information. So if states don't go this route, then it's going to be a real challenge for businesses to comply, because ultimately, you can't, until the marketplaces start requiring this information, you can't really force people to give their KYC. And so then you have to either narrow who you're selling to and have them go through your own platform or something like that, or you have to rely on the marketplaces to start to go down this road as well. So it's an interesting thing. One other thing that you mentioned in your chapter is you talk a little bit about how if there is no sales tax, and correct me if I'm wrong on this, but if there is no sales tax applied to the sale, then it goes to the purchaser it's their kind of.
Well, there's sales tax and there's use tax, and in most states they go hand in hand, where if sales tax should have been collected at the point of sale and it wasn't, then the purchaser is required to pay use tax when they file their returns. Now, historically speaking, use tax has been very, very difficult for states to enforce. And I think, looking at it from an enforcement standpoint, in where they're best to invest their time and resources, it's usually going to be targeting the sellers rather than the purchasers. But the purchasers, if all of these platforms that haven't collected NFT sales taxes have basically left them with this tax conundrum of should they claim use taxes on their NFTs. Now, use taxes are very hard from a collection standpoint, obviously. But one thing that's interesting with NFTs and digital assets, they're transacted on the blockchain. It's an immutable ledger, and in many cases, people are actually filing a lot of the information related to their transactions with the IRS, and in many cases with the state. So, even at the individual level, there's a high likelihood that the state departments of revenue can get knowledge that you are purchasing NFTs, and they can start to look at it from that perspective too. I do think that's less likely than them targeting marketplaces and sellers, just because there's going to be more sales volume when they target them, but it's an added risk.
I think
and a compliance issue.
Yeah, I think an important, I'll come to Brendan in just one second. An important thing to note here is that, and we talk about this all the time, is, even if the IRS doesn't know who you are right now on chain, the vast majority of US participants in the crypto industry have KYC'd at some point. So even if the IRS doesn't know this information now, they will likely know it within the next 5 to 10 years. And so then if you're underreporting, whether it's fraudulent or it's just a gross underreporting, that extends your statute of limitation on these issues as well. Yeah. So Brandon, did you have something you wanted to add?
Yeah. Could you dive in a little more about like gifting NFTs and how the taxable events in that situation would be? Would it depend on the use case and the utility of the NFT, or how would that work?
Well, honestly, I haven't really considered that question deeply, but my first thoughts on gifting NFTs would be that, there's zero sales price, so there may not be any tax applicability there. But that is a really good question and something I'd have to look into further, because I don't specifically know the answer to that.
Gotcha.
That's great though. I say that anyone who knows the answer to everything shouldn't be trusted. So another thing that I wanted to ask you is just, you've already touched on it a little bit, Patrick, but is just, could you go a little bit deeper on kind of the impact of Nexus and the location of both the seller and the purchaser as to like where and if sales tax should be collected?
Yeah, so, there's like, going back to basically, there's like 3 pillars. So from my perspective on when sales tax is going to apply to an NFT, the one we sort of covered was the underlying products. The second one would be sourcing, considering the purchaser's location as well as the seller's location. And there's variability, like with Washington, they will look through at the seller's location. They're the only state that has stated that yet, but they're also the state that, from my perspective, has been out ahead in terms of providing guidance on this issue. So, we'll see if other states do that. Then the third consideration, once you've considered underlying product, once you've considered sourcing, then it comes down to your nexus. And there's basically 2 forms of nexus. One is your physical nexus, which is, more or less self-explanatory. If you have a physical presence in that state in the form of your business location, employees, things like that, you're going to have a physical nexus in that state, and you're going to have to collect sales taxes in that state when it applies under, sourcing and underlying products. The other big one that was as a result of the Wayfair decision was economic nexus, which varies on a state-by-state basis, but basically you can have a nexus even if you don't live in a state, and an NFT seller could possibly have a nexus in every state in certain scenarios, because economic nexus basically says you have a nexus in a specific state if you've sold a certain amount of units in that state and or a certain dollar threshold, which again varies state to state.
Okay, great. I'd love to kind of open up the floor if anyone has any questions for Patrick and on any of these issues. And I know he's touched on a lot of it. But yeah, if anyone has any other additional questions for Patrick on this topic.
Hey, it's Kathy. I have a question.
Sure, yeah, go ahead.
So I'd have trouble sometimes understanding with an NFT how you have an actual thing, a physical thing, from which you then sell extra things from the NFT. Like you produce a movie and the movie has value, and then you're selling from the movie. Or you have a car, or you have a house, and then you sell shares of the house for people to own part of the house. So somebody owns the house, and then somebody else maybe owns, kind of like a timeshare, owns parts of it. So in that case, how does tax and sales tax work? Like if you buy a house and you pay tax, well, it's probably not, you're not really paying tax, but you buy something and you pay sales tax on that. Then if you divide it up and you sell it to other people, then would the government collect more tax on the divided up part? I mean, it just seems like there's an awesome opportunity if you're a government to collect lots of duplicate types of tax, but I might not be thinking it through right.
So fractionalizing the ownership of assets or like things like that when NFTs, I think that's an interesting question. That's another one I haven't given deep thought to. My first thoughts would be that, it's going to go back to what the underlying product is that you're selling and where sales taxes applies to there. It may also depend on, again, the underlying asset, like is this going to be looked at as a security, or is this just going to be looked at as, whatever it is that you're selling, if it's a house. So that's actually a really good question, and one I should look into more in terms of fractionalizing ownership. But we have seen states like Washington address royalties, and they are applying B&O taxes there. So yeah, I'd have to look into if the fractionalizing ownership more.
I think a good rule of thumb.
It's just,
sorry, go ahead.
Yeah, it's something that's just developing, really. What were you going to say, Tom?
I think a good rule of thumb is to always, kind of as Patrick alluded to, is you look at kind of what inherently is happening with the transaction. So like, let's say, for example, you are fractionalizing a house or a car or something like that, and you would pay sales tax on the car for reselling that. Well, I mean, it wouldn't really be double taxing if you're collecting sales tax on the individual fractionalized portions, because it's just a piece of that sale. So let's say you divide it into 10 pieces. The same sales tax would be collected as if you sold that to one person. It just would be divided between 10 different parties, right?
Yes.
In that sort of situation. So there wouldn't really be any additional sales tax applied. It would just be a bit more complicated because you'd have 10 parties instead of one, right? That's just my initial thought. Like I like Patrick, haven't looked into this too deeply, but I try to always kind of put on my hat where it's like, okay, if this were just like literally a car, sale, and there was a sales tax applied to it, what would happen? And then now what's the difference here is the only real difference would be that you're dividing it up, right? Now I may be way oversimplifying it, but that's kind of the way I look at it, is just put on that accounting theory hat and just say, okay, what is this most like? What is it most like in the real world?
Yeah, that's what I would anticipate there. And I think much like bundled transactions, that need to be an area where there's future guidance, but it is likely that they're probably just going to, look through at the underlying product. That's where most of the guidance is going right now, and base it off of that.
Yeah, and I guess really when there's more uses, then there's more tax. Like if a small town
Oh
builds
yeah.
a swimming pool and then they get tax, they can charge tax on the swimming pool. But
Yeah,
then when there's memberships and people buying snacks at the swimming pool, it's just every time there's more
Yep, it's actually
revenue
called the
opportunity.
consumption. It's called the
That makes a
consumption
lot of
tax.
sense.
Yeah,
Oh,
they're
that makes
taxing.
sense,
Yeah, but it's a very good point.
Thank you so much.
Yeah, I think too, it's interesting to hear you talk about like these platforms that are not doing KYC and they don't have any understanding of that. Where in our use case, we recently released our NFT, which initially the main utility is lifetime membership to the community. So we'll easily be able to tie the NFT purchase to an individual and then be able to
Nice.
work on, well, I should say Brian will be able to work on the taxable event from that point, knowing where the individual is located. And I think just to continue, part of these Water Cooler Wednesdays, the goal is to find new issues and topics and kind of deep dive into them. So the fact that we haven't talked about the gifting element is interesting to me. So I'd like to provide a little more context. So when we minted our NFTs initially, before we put them up for sale, we gifted a few to family and friends. We gifted a few to kind of like the core founding team members. And then we just started thinking like, okay, how would that be taxed? Because like the core family and friends, maybe they're looking at it from an investment perspective where the value of the NFT would go up and then they could sell it from there. Whereas some of the team members, they provided services or are providing services, and it was our way of saying like, thank you. And, here's your lifetime membership. So I'd like to just throw that on, for future reference, how we would kind of work that.
Yeah, I think the gifting is a really interesting issue. Like I said, if it's a zero sales, then that's sort of my first thoughts. But then again, usually, if you're gifting something like that and it's for business purposes, they'll have to claim that as income. So then we may need to apply some sales taxes there. It's sort of it's definitely an interesting issue that requires more investigation.
And I don't know how often it would happen. I mean, most people create NFTs to sell them. So I mean, I don't know how often it would happen.
You also have the free mints too, which again, I would expect probably a zero sales tax on that, but it shouldn't go without consideration for sure.
It's almost like if you treat it as having a fair market value for income tax, then you would have to apply a sales tax based on the amount of the income.
Yes.
But how are the sales tax collectors going to know when it's a zero transaction that sales tax is due unless you self-report?
I would think that
unless you self or they audit you and they look at the product and what your sales price is for it, and then they could apply it based off of that potentially. But it would definitely require an audit in that case. But I didn't mean to interrupt there.
No, that's fine. Yeah, I would think that I thought of it in the way of your initial point where it's like it's a zero sales price, and it was at a time before we had put any up for sale. So at the time there wasn't any equivalent sale that happened, and also no sales price attached to them. So yeah, it's an interesting thing. We'll have to do some more investigating on that. But yeah, it kind of brings up the point that this is a very kind of unresearched area, and that's kind of what brought our attention towards you, is that you were one of the few people that I've ever seen talking about this. Not that I overlooked it, but it's just like something that you don't necessarily think about because it feels like a digital good, and it doesn't necessarily feel like typically you associate sales taxes with a physical kind of interaction, and you don't necessarily always think about them in a digital realm, even though there are, like you say, in 31 states laws on the books for this. So that was the reason why we originally kind of you caught our eye. And then we invited another person from the UK to speak on kind of VAT taxes. Sales taxes are called VAT taxes in most of the other world. And not to put you on the spot, and I totally understand if you don't, but I'm wondering if you have any kind of insights into kind of more global perspective on these types of taxes.
Yeah, I couldn't rattle off specific countries, but I'm well aware that VAT taxes, just like sales taxes, is going to apply in most countries to NFT sales. I think, considering many of the factors that we've already discussed here are going to come up on an international perspective. I've been much just focused on the US currently, so I
Plenty
couldn't
to focus on there.
yeah, I couldn't provide specifics on that, and most of my clients are in the US too. But I'm well aware that the VAT tax is there, and it's definitely gonna apply in at least some countries.
Yeah,
and that's why I see some people on, NFT taxes sort of feels like crypto taxes did to me back in like the 2016, 2017 timeframe, where there was more people probably not reporting back then than were. There was many people unaware that they even had reporting requirements, and then people that even do want to report, like I've made many people aware of it. They need to have a solution for that as well. So there's many challenges, sort of, with like, just like I said, just like I saw with crypto taxes years ago, we see it's sort of like the next wave of this now with sales taxes to NFTs.
Yeah, I think back then it was a lot more. I think the ethos, it was either, like you say, either people that were unaware of their tax obligations, or people that were just like, nope, if I can't figure this out, how can the IRS figure this out? And the kind of libertarian viewpoint that a lot of people.
Lack of guidance, and just the pseudonymous aspect that they confuse with anonymity, I think, in a lot of cases.
Right.
Like you're alluding to, it's not that difficult to tie an identity to an address, especially if you're going to use centralized off-ramps. And, that's going to be a huge issue for people. And likewise, now, a lot of people are saying, well, we're not giving our address and our information to the NFT platforms, but, that type of stuff doesn't really last in the long term. Basically, as you see now with the maturity of like tax and accounting in the digital asset space, ultimately, if you want to be a serious player selling NFTs or be a marketplace, you're going to have to get into compliance with these states.
Well, I mean, you see it with ETH already. The ETH network is it's over 70% OFAC compliant. So even the major networks are obviously Bitcoin, no, but you also can't trade NFTs on Bitcoin. So it's an interesting issue, and I really appreciate your time here, Patrick. I'll just give people one more opportunity if they want to ask any more questions. Just before we start to wrap this up.
One other point in terms of the challenges with the NFT collecting outside of sourcing, another big issue is then you need to collect the appropriate amount of sales taxes in real time from the customer at checkout or mint. And obviously that has to be done in your native cryptocurrency, because usually they're going to be minting the NFT in their cryptocurrency. So, if you have a 10% sales tax rate that's going to get applied to someone at the point of sale, you're going to, need to collect that in Ethereum, so 0.10 Ethereum, and then be able to have reporting on the back end that breaks that all out properly for accounting purposes.
And then you likely want to probably convert that to USD as quickly as possible to kind of mitigate your
that's what I recommend. That's what I recommend to clients in general, from a tax perspective, at least, converting their tax payments, if not at least a portion of their treasury, anytime they make a sale. So that's definitely best practices from a capital management perspective. So the two big challenges is, collecting in the native cryptocurrency at checkout and being able to source the right tax rate for any NFT based off of the location and the underlying product.
Wow, lots to think about.
Then when you get into places like California, right? So I've had like cannabis delivery service clients in California, and every different town they deliver to has a different sales tax rate. So, it's 7.25%.
Oh, that's a really good point to bring up too, because, that's one consideration, like going back to right now, there's no information being collected. So one of the things I was looking at is, could we just start collecting customers' zip codes and, you know, cross-referencing the rest of the data to be able to determine what their sales tax rate is. In many cases that'll work, but like you're saying, there can be some issues in tax regions where local taxes apply, where sometimes a tax region and a postal region can be different. And if you're just using the zip code, you're not going to always be accurate in specific regions with those local and county rates. So the best practice is basically that you have to collect the full customer's address in order to get that rooftop accurate rate and be able to calculate the local taxes. But that's another point too. That was a good one, Brian.
Yeah.
Sounds like you're gonna have no shortage of business here, Patrick, in the coming years. And already, I'm sure.
Well, I'm actually have a software solution for this called Digital,
okay.
where we're basically providing that full solution where we're able to collect customer information at mint or checkout, then collect the sales tax in the native cryptocurrency, and then provide all the reporting on the back end to meet filing obligations.
Wow,
so
that's awesome.
yes, yeah.
I have one more too. What about NFT loans? How would that work? So if I had an NFT and I was on like a loan.
NFT loans, that's another one I haven't given much thought to before this video here, but I would expect that a loan probably wouldn't have sales tax applied to it. But again, that would be something I'd want to look into and confirm more.
So I can take this one.
Flyfish Club, right? Flyfish Club, you can lend that to me. I can use it, get utility out of it.
But that's not a loan. That's
lending.
That's like you're lending it out and you're receiving a payment for that. But in the case of like there's
I thought you meant collateral. Yeah.
No, I think that's what he did mean. And so in that case, there's no sales tax applied because there's no sale happening. And it's really just the same sort of thing as if you took a loan from anyone. It's non-taxable because it's not income to you. You have an obligation to pay it back. So it's the same scenario. We actually did a chapter in our book. I wrote it on borrowing against your NFTs, which I don't necessarily recommend because they're volatile. But yeah, you can the money that you get, it's not taxable because it's just like any other loan. It has collateral that it's backed against. You don't pay it back, that collateral gets taken. So yeah.
Okay, makes sense.
Anyone else?
That was great.
Thank you so much, Patrick. We really appreciate it, and we'll post the video in the community. We'll also kind of start a discussion around this within the community as well, and we can highlight the solution that you offer as well within the community. So would love to hear more about that. So we can maybe put a link to that in the video description as well.
Definitely. Well, I really appreciate you guys having me on, and I'm happy to be part of the community, and I plan to start logging in more and getting more involved on there, but I'm definitely happy to be a part of it, and I appreciate everyone coming here today and listening to me.
Perfect.
Awesome. Yeah, we're glad to have specialists in different areas, and I think a lot of our members will love to know that there's someone who specializes in the sales tax piece of things, because not many people want to touch that. So especially in this world. So appreciate it. Thanks, man.
Awesome. Yeah, I really appreciate it. Thank you a lot.